Hey everybody, welcome back to the Misty Meta Mastermind. And it is me, Side Income Dad, and I'm joined by Migs. What's going on,
Hey,
Migs?
not much. Hey, everyone. Happy Father's Day to everyone out there.
Yes, sir. Happy Father's Day to all the fathers out there. Chanimal was not able to make it for this showing, but he'll be back next week. No worries.
Yup.
All right, so we wanted to start off with touching base on last week's TSLY estimate. We gave an estimate of 80 cents,
Easy
and
four for
they
me.
yeah. And then they paid out like in the 40s. And so pretty big difference. I wanted to address why there's such a big difference. And the main thing is Tesla was kind of in the hole. Like they were in the negative, and so they had to, keep some of that. Ultimately, I do think it was a wise choice, and I agree with that choice that was made. I don't know how you felt about that, Migs. What do you think?
Yeah, it was just a little bit disappointing, but after thinking about it, you realize you don't want the stock price that's already kind of low to go even much lower.
Yes, absolutely. That kind of brings us into this week's estimate with Platy. As you can see here, we lost money. We lost money on the weeklies. We lost money on the synthetic. I mean, technically, this is the loss, $3.18. So this is kind of, obviously this is not ideal, but this is a great example of what can happen. The last month, Platy made so much money, they actually made $15 per share, and they
Bank.
they paid out seven, right? So like, yeah, they made out bank. But the reason why I bring it up is because we're still going to estimate that they're going to pay a positive amount rather than not pay anything at all. And the reason for that is because we know that Platy has some money in the bank. So they have something in reserves that they can use to pay out a dividend. Now, traditionally, in a situation like this, you kind of expect the IV payment. So you would kind of expect this $2.87 per share. But with knowing that they've got quite a bit in the bank, I just feel like they're probably going to pay $4.39.
Yup.
That's my guesstimate. I can break that down if any of you want, but Migs, I wanted you to kind of give your thoughts and your estimate.
Yeah, that's not bad. That's probably like around a good 10% from what the stock price is at, which you usually do between like six to 10% of the stock price.
Yeah, you know what? Actually, I love that you brought that up, because I made the numbers kind of be even, I would say, more accurate to the data. In the distributions tab, we've got pretty much every payment that they've made. And then I went ahead and typed in all the like closing prices for all of these. So now we're using that payable date, finding out the closing price essentially a week before that. And I want to look at the yield of what they're doing. And so, as Migs just said, they pay anywhere near that 10% on the highs. And then obviously in this case, the lows are maybe 4.5 or 436 here. But I'm
Mm.
taking these numbers, and these are the numbers that are then capping what the high estimate is and what the low estimate is.
Mm.
So it's really cool because now, like historically, we're using what they've done in the past to predict what they may do in the future. So I
Nice.
just I just kind of wanted to bring that up because again, that changes for everything. So like if we go back to Misty, then this is going to change and it's all loading, but there you go. It still gets updated and we still get to see what's going on. So it's going to work for all of them. But yeah. All right. So back on the plating, like yeah, rough month, rough week. I do want to point out though that I don't think that this is cause for concern. Palantir is still a company with strong fundamentals. And, I guess another thing to bring up here is this whole Iran and Israel war that's going on. Um, I don't know if the US will or won't get involved, but if they do, Palantir will be one of the things that is a big deal here. And so, this may be a potential for them to go up in price. I think we're up for a very interesting week in the stock market here. I think everything else is probably going to drop.
Probably. Except for like tech stocks.
Yeah, yeah, I agree.
which is
Um,
cool because like Palantir has basically all those government contracts, so that's why you're saying that.
yeah, exactly. Exactly. Now, something else we wanted to kind of touch base on today is pretty much what is this covered call strategy? Like everyone talks about it. I feel like there's a lot of misrepresentation out there, and I wanted to really go into a really simple, I guess a simple example of what it's doing. And so ultimately, and I kind of used Misty here, and I just wanted to show you all kind of how that works. But really, Misty is buying like MicroStrategy stock, but they're buying it through synthetic calls. And then what they're doing after that is since they have a synthetic holding of MicroStrategy, then they do these short calls. And it's only 1 week until it expires. And they just do that every week. And that's how they generate income for us. So we'll go ahead and break down some of these examples, but I just wanted to kind of touch base on how it really works, how it's done. And on that note, I also brought kind of the holdings that each one of these is doing. And I'll dive into during the example why this is important. So let's jump into this covered call section that I created just for this. And this is kind of the breakdown. So let's pretend, right, that we bought this is the date. So this would be like the date that something's being done. So let's say that on the 5th, which was a Thursday, they bought the synthetic. So these two are the synthetic. What does that mean? They're selling a put and they're buying a call at the same strike price and for the same strike day. What happens is when you do that, you're selling a put, you're making $16.96. And then for the call, when you're buying the call, you're paying $36 dollars and 8 cents. And this is per share. And when you're doing options, every single contract is 100 shares. So if I times this basically by 100, you made close to $1,700. So there's 1,696. And here you had to pay $3,608. Now what does that come out to be? That comes out to be $1,912 that it cost you. Right. So that's how much you ultimately had to pay to get this synthetic position. Now, right away, that's a huge win. Why? Because if you were to buy $100 of MicroStrategy at that stock price, that's what column H is going to be, just the current stock price of that. By the way, that number is manufactured. I didn't actually go back and take a look and put those numbers. This is for example purposes, so I made them really simple and straightforward. But going back to this, if I wanted to buy 100 shares of that, you times that by 100 then this is how much you end up with. Like that's quite a lot, right? Like that's a lot of money for you to own 100 shares of MicroStrategy, as opposed to just paying close to $2,000 to synthetically hold the equivalent of 100 shares.
Wow.
So I hope everybody's with me so far, but that's the first benefit of the synthetic holding and that Misty and PLTY and all the stocks that we hold to. Now that we hold a synthetic position, since the stock price is at 380, we can say, you know what? I'm going to go ahead and sell this short call at 385. So I'm saying I think the strike price is going to go to 385, but not hit 385. It's going to be somewhere below 385. I think the expiration date is going to be 6/13. That is just the following Friday. And so
Mhm.
someone out there is going to buy this contract. They're going to pay us $5 a share. Again, 5 times 100, because you have 100 shares in one contract. That's $500. So you just got paid $500. You still have your stock. Nothing has happened. You just made a deal. Now the next week happens, and this is the week where we're going to use an example where we win. You wait till next Thursday. Why next Thursday? Because you don't want your contract to end. All right. So, and it ends on Friday. So on Thursday, we're going to take action and we're going to say, I'm going to buy to close. Again, look, same strike price, 385, same strike date, 6/13. We're just closing that out. That's all we're really doing. Now, in order to close it out, you have to pay a fee. So in this case, we're going to pay $1 per share. So we just lost $100. So when we look at this transaction here, as long as that price was $384, we actually made $400. Why? Because we got to keep our shares since it did not hit 385 and we closed it out early, so we had to pay a fee. But ultimately, we still ended up with $400 because 500 minus 100 nets us $400 for that week. Now, we know the stock price is at 384, so we opened a new call. We still have 100 shares, right? We still have that one contract. So now we're going to say, okay, we are thinking that the stock is going to stay under 390. So we'll choose a strike price of 390, a strike date of, again, next Friday. And then this time, volatility maybe dropped a little bit. And so they're paying less. So they pay us $4. So now we got $400 just to open up this contract. Now the next week comes along, and this is an example of a losing week. So what happens here? The stock goes to 395. That's $5 above what we expected it to be. So again, Thursday comes along, we have to go close that call. And this time we have to pay $7 to close the call. Why? Because it blew past our strike price. It's at 395 now. We thought it was going to be under 390. And so we have to pay to close this contract or we lose our shares, right? And remember, we don't actually have the shares. We have a synthetic position. And so therefore, we're going to close it out. In this case, we lose $300 because we got $400, but we had to pay $700 to close it. So that's the loss of 300. Now, again, we still have that synthetic position, so we're going to buy another call option here or sell another call option, I mean. And in this case, we're saying we think the stock is going to go to $400 and we get another $4 per share, so we make another $400. Next Thursday comes along, we close that same position, right? 400 strike price, same date on the expiration. But because the stock is at 396, that's pretty far away from 400. So it doesn't even cost $1. It's 80 cents to close it. So we pay $80 here. That's that means we netted a profit of $320 for that week. Now, in this example, I call it exit early. What does that mean? That means that I want to get out of this synthetic. And so just like all these other calls, we have to close it. So for the put, you have to do a buy to close on the put. Now, the strike price was 370 and now the stock is at 396. So we only have to pay 50 cents per share to close it out. So look at that, $50 to close out this position. But again, the stock is at 396 and we've got this at 370. So in order to close this call that we bought, we do a sell to close, and that sell to close is going to pay us $29 per share. So then we made $2,900. When we add this all up, we end up with $1,358. And so I think that's super solid. That was a win that you made, and over a very small investment. So you really got to cash in on that money. Uh, any questions or anything you want to add on to that, Migs?
No, not really. I kind of knew the basic concept of it, but like actually going this deep into it, like it kind of makes you value what they're doing at Yieldmax a little bit more. Like
Yeah,
it
yeah.
seems like it's a lot of work for sure.
It's tons of work because
Yeah,
they do this weekly and they hold thousands of contracts. This is just an example of one contract.
yeah, and that's not
Um,
even like the trades that they actually go in and out on the same day,
yeah,
like multiple
exactly.
times.
That's right. That's right. So again, if there's any questions on this, please drop them in the chat. I'd be more than happy to go into them a little bit deeper, but I'm hoping that this helps everybody understand how it is that they make money. So where does that dividend income come from? It comes from this. When you see the price of the stock go up and down in terms of, Misty or Plate or any of the other ones, it's doing those things because like the price of the underlying stock is going up and down. And can that pay us? Of course, right? In this case, we would have made this chunk here from that. So of course it can pay us. But
Yep.
whether it goes up or down, that sideways play is still getting you income through here. As you can see, it's usually not going to be as much, but it's still income.
Yeah, and then
And
and then it gets divided by the total outcomes, outstanding shares, right?
yeah, exactly.
So
There's a bunch of degens like us in this fund, right? So we're all trying to get paid.
for
Uh,
sure.
and to like, if you don't think that these prices are like accurate, I just want you to remember this 1696, okay, and this 3608. Let's go back to this podcast screen, and where did we go? Oh, I think it was in summary. But like, I mean, look at these numbers, right? 30 something dollars, 19 something dollars. But then when you're doing these weekly trades, $4, $4. Look at these. Like those prices that I put in there in the example are actually pretty close to realistic prices, 27, 22, like $2. Like look at this buy to close. This was closing 54 cents. Um, so yeah, like those numbers are actually pretty real. They're
Wow.
very, very realistic to what happens in real life. Um, yeah, so again, any questions on this, I'm more than happy to answer them. Just drop them in the chat. We can cover it next week or yeah, we can cover it next week if need be. Okay, so the next thing that I wanted to talk about here, we wanted to, as always, share the income that we've made. We
Yeah.
tell you all that we're in all these funds and it's quite true. We're in all these funds. And so it doesn't mean that we put the same amount of money into every single stock, but for this week, we've got, and here, let me make this a little bit smaller. Maybe that's probably good enough here.
Yep. Yep.
So for me, I had two payments, which is about $950. Chanimal got $201.40, and then Mix got $430 with 19 cents.
Hell yeah, getting paid.
Right. And remember, I want you guys to remember, we're not doing anything. Like,
We're just chilling.
that's right. Somebody at Yieldmax is doing all this, and we're the degenerates that are over here just collecting the
We're,
paycheck.
we're just going about our business, you know?
Yeah, yeah. And so amazing, amazing work by the team over there. I'm always happy about that, always proud of that.
Yep.
But just wanted to share with everyone here. This is how they're making money. All right, everybody, we're gonna keep it short. It's Father's Day weekend. I hope you're all enjoying the weekend. I hope you all had a great day today. But yeah, that's it. That's it for today's podcast. We'll see you next week where we are going to talk about what's next, Coney?
Coney for sure.
All right,
Group
sounds
C.
good. Yes. Yep. Thank you all.
All right, thank you everyone. Happy Father's Day. Enjoy the rest of your night.